There's a guy I know who spent 34 years working at the same logistics company. Same commute, same desk, same Tuesday morning meetings that could have been emails. He gave that company the best decades of his life. And the day he finally handed in his resignation letter, he did what most people do. He told everyone immediately. Posted on LinkedIn, called his siblings, had dinner with neighbors, celebrated the way you're supposed to celebrate when you cross the finish line. 6 months later, he called me. Not to celebrate, to ask me why his tax bill had doubled, why his Medicare premiums were about to spike by $800 a month, and why nobody had warned him that the withdrawal strategy he'd been using was quietly undoing 30 years of careful saving. He hadn't made any dramatic mistakes. He hadn't gambled his money or trusted the wrong person. He just moved too fast in the wrong order. He announced before he upgraded. And by the time he realized what he was missing, some of those decisions had already been made for him. Here's what most people don't understand about retirement. The moment you tell people you've left work, the calendar fills up. Trips get planned, dinners get scheduled, family starts calling. Social pressure builds before the structural work is done. And once that pressure exists, the important decisions start getting made reactively, in between other things, under the influence of what everyone around you thinks you should be doing. The people who come out of retirement with their money working exactly the way they intended are almost always the people who spent the first stretch doing things quietly, before the announcements, before the celebrations, before the world had an opinion about how they should be spending their time. So today, I'm going to walk you through the 10 things you need to upgrade the moment you retire, in the order that they actually matter, and explain exactly why sequence is as important as the decisions themselves. Because doing number 8 before number 1 is like building the second floor of a house before you've poured the foundation. The result looks fine until something shifts underneath. Upgrade 1 is your withdrawal strategy. While you were working, the financial question was simple. Save as much as possible and park it in the right accounts. The moment you retire, that question inverts completely. Now the question is, which account do you pull from, how much, in what order, and at what point in the calendar year? Most people default to whatever account has the most money in it, usually the traditional IRA, because that's where decades of contributions have piled up. That seems logical. It is a mistake. Every dollar you pull from a traditional IRA creates taxable income. That income stacks on top of Social Security. That stacked number pushes you into higher tax brackets, and that same number affects your Medicare premiums, sometimes dramatically, with a 2-year lag you won't see coming until it's already hit you. Think of it like a long hallway with trapdoors in the floor. You're walking through retirement, and every withdrawal decision you make today is either opening those doors or closing them for the next 30 decades. Most retirees don't build a map of the hallway, they just start walking and hope for the best. The upgrade is to know exactly which account funds you're spending in year 1, identify the optimal window for Roth conversions before required minimum distributions force your hand at 73, and structure your income to keep your taxable base as low as possible while your brackets are still in your favor. The people who get this right in the first year make better decisions for the next 30 years. The ones who don't are essentially setting a tax tone they'll be living with for the rest of their retirement, and most of them won't even realize it happened. Upgrade 2 is your health insurance. If you're retiring before 65, your employer coverage ends on your last day, and you need to bridge the gap to Medicare. This is not something you figure out after you leave. By then, your options have narrowed, and the cost of the wrong choice compounds immediately. Here's the math most people miss. Marketplace insurance through the Affordable Care Act offers premium subsidies based on your reported income. In 2026, those subsidies have been tightened, but they're still significant. And whether you qualify for them and how much they're worth is directly determined by the withdrawal strategy you built in Upgrade 1. If you're pulling large amounts from traditional accounts, your reported income spikes, the subsidies disappear, and suddenly you're paying full marketplace premiums out of pocket. With a correctly structured withdrawal plan, a retiree bridging 5 years to Medicare can save tens of thousands of dollars in health insurance premiums simply by managing which accounts fund which spending. That's not a rounding error, that's a car. That's a year of travel. That's money that was always yours to keep, but slipped through a gap most people didn't know existed. COBRA exists as an option, but it's expensive, and in most cases, marketplace coverage with managed income produces a meaningfully better financial outcome. Model this before your last day of work, not the week after, because once you're out, the decisions available to you are different than the ones available while you're still in. Upgrade 3 is your tax plan. While you were working, tax planning had a simple shape. Maximize the 401k contribution, maybe itemize, let the employer handle withholding. In retirement, the tax plan has to cover 25 to 30 years, and every decision in year 1 echoes into every year that follows. Bracket filling, Roth conversions, capital gains harvesting, IRMA management, these aren't exotic strategies reserved for the ultra-wealthy. They're the basic arithmetic of retirement income, and they have to be mapped before you start spending, not reconstructed in April when the year's income is already locked in. Think about what this actually means. You have an account that's been growing tax-deferred for decades. The government has a claim on every dollar in it. When you start pulling that money out and at what rate determines how much of your own savings you actually keep. Most retirees discover this relationship too late to do much about it. The ones who build a lifetime tax model before pulling the first dollar treat every withdrawal like a move in a chess game, not a transaction at an ATM. Upgrade 4 is your beneficiary designations. This is one of the most important actions on this list, and the one that takes the least time. It can also be done at zero cost. Most people set their beneficiary designations when they opened their retirement accounts years or decades ago and haven't touched them since. Here's the problem. That designation overrides your will. It overrides your trust. It is a legally binding document that determines exactly where your retirement assets go, regardless of what you said anywhere else. I know a man, we'll call him Robert, who spent years building a careful estate plan with his attorney. He had a will, a trust, the whole structure. He updated everything except one form on an old 403(b) from a job he'd left in the 90s. When he passed away, that account didn't follow his estate plan. It followed the form. The resulting tax outcome for his heirs was significantly larger than it needed to be and required court involvement that took months to resolve. On the other side, there's a man I know who updated his designations 2 months before an unexpected illness. His accounts passed cleanly to his 2 sons, without dispute, without delay, without unnecessary tax consequence. One form, 30 minutes, filed and done. The upgrade here is simply to review every account, every policy, every retirement vehicle, confirm that the beneficiary listed reflects your current wishes and your current estate structure. Do it this week, not this quarter, this week. Upgrade 5 is your estate documents. Most people drafted their will and power of attorney when their children were young, and their financial picture looked completely different than it does today. Those documents have been sitting in a file drawer ever since. Retirement changes your income sources, your account structure, your overall financial complexity. The estate documents you wrote 15 years ago may not reflect any of that accurately. Your healthcare directive, your power of attorney, your trust documents if you have them, all of these need to reflect where you are right now, not where you were when your oldest kid was in middle school. If those documents are outdated and something happens, decisions about your money and your care get made by default, by courts, by whoever has the loudest voice in the room, by processes you have no control over. Updating these documents isn't complicated. It does require a conversation with an attorney, and it requires setting aside an afternoon. The reason most people don't do it is friction. The task feels heavy, and there's always something more immediate competing for attention. The upgrade is to remove that friction and treat updated estate documents as a structural requirement of retiring, not an optional to-do that floats indefinitely into next year. Upgrade 6 is your insurance coverage. The insurance you carried while you were working was built around your working life. Disability coverage protected your earned income. Life insurance protected dependents who relied on your salary. Some of that no longer applies. If your income is now coming from accounts rather than employment, disability insurance is no longer relevant. If your spouse is financially secure without your earnings, life insurance may no longer need to carry the same premium weight it once did. The upgrade here cuts in 2 directions. First, identify coverage you're carrying that no longer serves a purpose and eliminate those premiums. That's money being spent on protection that's protecting something that doesn't exist anymore. Second, understand what becomes more important in retirement. Umbrella liability coverage matters more when you have accumulated assets to protect. Long-term care planning matters more when a medical event could last years and cost more than most people project. The goal is not to spend less on insurance across the board. It's to make sure every dollar you spend on coverage is actually protecting something real. Upgrade 7 is your cash reserve. During your working years, 3 to 6 months of emergency savings was the benchmark, and it worked because a paycheck was always coming. In retirement, cash needs to be thought about differently and more deliberately. The starting point is a true emergency reserve, somewhere between 6 and 12 months of living expenses in something stable and immediately accessible. Not for normal spending, for the unexpected. Medical costs that land outside the plan, home repairs, the kind of thing that shows up without an invitation. Beyond that emergency buffer, any major known purchases in the first 2 or 3 years need to be identified and set aside separately before you start drawing from your investment portfolio. A car replacement, a home renovation, a significant trip. If those amounts aren't clearly defined and accounted for in advance, they create unplanned investment sales at exactly the wrong time. You're pulling from your portfolio not because your retirement plan calls for it, but because something came up, and unplanned portfolio withdrawals are almost always more expensive than planned ones, both in tax cost and in long-term compounding impact. This isn't about holding excessive cash, it's about making sure your investment portfolio can do its job without being interrupted by short-term needs. The discipline here is the same discipline that separates the people who build wealth through market downturns from the ones who sell at the bottom to cover expenses they didn't plan for. Upgrade 8 is your actual spending number. Most people enter retirement with a rough estimate of what they spend each month. That estimate is almost always wrong. It's usually based on what they imagine they spend, filtered through the assumption that retirement spending will look like working life spending minus the commute and the work clothes. It doesn't work that way. Spending patterns shift in retirement. Healthcare costs increase, travel frequency increases. The structure of daily spending changes in ways that are hard to predict from the outside. Here's the mechanical problem with using an estimate. Your withdrawal plan, your tax plan, your cash reserve, all of it is built on a number. If that number is wrong, everything downstream from it is wrong too. It's like using an incorrect measurement to cut every piece of wood in a house frame. Each individual error seems small. The accumulated result is a structure that doesn't fit together. The upgrade is to track actual spending for the first 3 to 6 months of retirement and build your withdrawal plan around the real number, not the imagined one. Better yet, start tracking before you retire and run a rehearsal. Treat the last 6 months of your working life as a trial run for your retirement budget. Discover your real number with a paycheck still coming in so that when the paycheck stops, you already know exactly what your life actually costs. Upgrade 9 is your Social Security analysis. Most people look at their Social Security statement, see a monthly benefit amount at age 62, a higher one at 67, a higher one still at 70, and pick the age that produces the number that feels right. That is not the same as having a Social Security strategy. The optimal claiming age is not a function of which monthly number looks biggest. It's a function of how your claiming decision interacts with your withdrawal plan, your Roth conversion window, your IRMA exposure, and the way Social Security income gets taxed at different provisional income thresholds. A man who claims at 62 because he wants the money sooner might be making a decision that raises his tax bill for the next decade and costs him more in lost benefits than the early payments were ever worth. A man who waits until 70 without modeling his specific situation might be creating a gap that forces him to pull more aggressively from his taxable accounts during the waiting period, triggering tax consequences that dwarf the benefit of the higher monthly payment. The upgrade is to run the analysis before you start spending, not after you've already claimed. Build your withdrawal plan around your claiming decision so the two are integrated, not in conflict. The people who do this up front lock in the timing that creates the best long-term outcome. The ones who claim based on the monthly number alone often leave significant money on the table and never realize it happened, because by the time the math becomes visible, the decision is already irreversible. Upgrade 10 is your survivor plan. This is the one most couples skip entirely, and it's the one with the longest tail of consequences. The assumption most married couples operate on is that when one spouse passes, the surviving spouse will be essentially fine. There's the house, there are the investments, one Social Security benefit continues. It'll work out. Here's what most people don't model. When one spouse passes, the surviving spouse files taxes as a single filer. Single filer tax brackets are compressed. The standard deduction drops. Required minimum distributions continue at the full traditional account balance. Social Security taxation thresholds shrink. IRMA surcharges hit earlier and hit harder. The surviving spouse can end up paying higher effective tax rates than the couple ever paid together, with less income and with one fewer person in the household to absorb those costs. If the traditional account balance is large, this isn't a minor inconvenience. This is a tax problem that can persist for 15 to 20 years. The mathematics of survivor income isn't something that happens to careless people. It's something that happens by default when nobody ran the numbers in advance. The upgrade is to model the survivor scenario early enough to do something about it. For many couples, this analysis is the clearest argument for accelerating Roth conversions while both spouses are alive and the tax brackets are still wider. Converting now means a lower traditional balance later. A lower traditional balance means smaller forced distributions hitting a compressed single-filer bracket when the survivor can least afford the tax hit. This is not a comfortable conversation. It's also not an optional one. Now, here's the part that ties all 10 of these together, and it's the thing my friend who left work and told everyone immediately learned the hard way. The moment you announce your retirement, you lose a specific kind of quiet. The calendar fills, people have opinions. Spending decisions start happening before the structural decisions have been made. Trips get booked before the withdrawal strategy is set. Social pressure builds before the tax plan exists. And once that momentum is in motion, it's very hard to stop and say, wait, I need to back up and build the foundation before I continue. The 10 upgrades on this list are not luxury items. They are not complicated. They do not require a finance degree or a decade of investing knowledge. They require a window of time when the noise is low and the thinking can be clear. That window exists between the decision to retire and the announcement that you've retired. It's short. It doesn't come back. Think of it this way. Most people treat retirement like a destination they've been driving toward for 30 years. They arrive, they get out of the car, they start telling people they've arrived. The 10 upgrades are the equivalent of checking the map, confirming you're actually where you think you are and making sure you have everything you need before you lock the car and walk away. If you skip that step and you're in the wrong place or you've left something essential behind, you find out later, and later is always more expensive than now. The people who retire and never look back, who build income that outlasts them, who pass assets cleanly to the people they intended to benefit, they are not smarter than everyone else. They are not luckier. They did the unglamorous structural work before the celebration started. They upgraded quietly before anyone was watching. The tax plan, the withdrawal strategy, the beneficiary forms, the estate documents, the insurance review, the cash reserve, the baseline spending, the Social Security analysis, the survivor model, and the health insurance bridge. 10 things. Most of them take a few hours at most, some of them take 30 minutes. All of them have consequences that compound across decades. You spent 30 or 40 years building the money. Spend a few weeks building the structure that protects it. Do it before the calendar fills. Do it before the social pressure arrives. Do it before the world has an opinion about how you should be spending your time. Because the goal isn't just to retire. The goal is to retire in a way that actually works for the next 30 years. And that starts not with an announcement, but with a plan.